Welcome to the Homeward Bound podcast by the Mortgage Guys, your ultimate guide to navigating home buying and mortgage lending. Whether you're searching for your first home or settling into your forever home, we're here to make the journey simple, clear, and exciting, helping you secure your dreams one home at a time.
All right, everybody, welcome back to another Homeward Bound podcast with the Mortgage Guys. It's Kyle Torgerson and myself, Dave Loescher, and we're here to talk to you again about all things home purchase related and finance. It's been a bit of a different time, I'd say, in the news and the hot topics right now, and one of which, obviously, I would say is the government shutdown, which thankfully has now come to an end. That's probably been the hottest topic. Knock on wood. Hottest topic we've seen lately, but in addition to that, Kyle, what would you say is the other hot topic in the economic world that you've seen today?
There's a substantial buzz about, trying to make things more affordable. The housing market is rough. The rate market's rough. Why not roll out a new product? We're going to talk about the pros and cons of this, but that 50-year mortgage is really what is setting social media on fire, the news on fire. And so, we want to take a few minutes today and talk about, what it is, what it means, what our opinions are about it, even opinions of first-time home buyers that, might see this as some glimmering hope in the future that they can get into a home and make it an affordable way to move forward, with life and get some financial stability going.
You're exactly right. And I think that it's probably been, 10 days, maybe 2 weeks tops from when we first started stumbling on this, I would say. And, the rumor just came out all over social media is that, President Trump introduced this thing as a new product that's going to push for home affordability, address the issue you just said, which is people can't afford to buy a home and people want to be homeowners. And that is a very real problem. In our industry, we face it day in and day out. So it's a very, very real thing. And then all of a sudden, after that introduction, so it's not even in law, it's not even a new program, it's nothing that the banks are offering at this moment as far as the mortgage lenders go, but yet it's huge buzz. I don't know about you, but if I go on social media, and maybe it's because we're tied, our professions are tied into this this is our profession. If I go onto social media, it is on my feed all the time, somebody else talking about this 50-year mortgage. And some people out there, it's the silver bullet. It's the answer to all the problems is what they think, right? But anything out there has the pros and the cons, and this one's kind of a bit of a double-edged sword in my perspective. What do you think?
I agree. Affordability is an issue. Now, this is the reason why it even came up. In the past, there's been a 40-year mortgage. Obviously, the 30 years been around for quite a while, but the idea is to try to spread things out. It's like going from a car loan that has a 3-year payment to a 7-year payment. That makes the payment smaller. But in reality, does going from a 30 to a 50 really make things better? But that's the buzz. Everybody is there's so much pent up demand to buy a home that they're looking for anything. Yep. Anything that can make things just a little more advantageous, a little more attractive. And so, stretching that mortgage payment out, does that do it? Does it not? And, we're going to go through the math. We'll look at it and see what it really means for us. But I think that's the reason why it's really come up is not to say creative financing, but you and I have both been in the business when creative financing came around. And not to say that this is that, but it kind of leans in that direction.
Yeah, for sure. And, just as we said, this is something that's been introduced by President Trump and, the chair, the director of the FHFA, which is the Federal Housing and Finance Administration, has shown some positive excitement. He likes it because it's going to help with affordability, which is the main issue that we deal with. I think the biggest challenge we have right now, we have a lot of young people young couples, they want to buy a house. And with these home prices where they're at, and interest rates, okay, I'm going to say it. We said it on our last podcast. We talked about interest rates. Is 5.875 to 6.25, is that high interest rates? I don't think so. You probably don't think so. We've seen worse, right?
Yeah.
But it's really not in the historic, long-term thing. It's not like we're in high interest rate times. We are at times where we have some pretty high prices on homes. I'm going to just say it. because of that, affordability under a 30-year mortgage has gotten to the point where people can't qualify. Not even that they can't fathom paying the payment. We can't get them to qualify with the qualifying ratios that we need to be able to give them an approval.
Yeah.
So with this new thing, as far as the pros of it all, like you said, it's going to make for a lower monthly payment. And a lower monthly payment means easier qualifying. Now, here's one little caveat I want to say really fast. In the past, we've had different programs that mean lower monthly payments. You can do the temporary buy downs where the interest rate is lower for the first year. However, that's not the payment they qualify on. They had to qualify on that 30-year payment, right? And if there was an interest-only product, we had those and negative amortization programs and those unique ones you just mentioned a minute ago. They still had to qualify on the 30-year payment. Well, now we have these challenges, like we just said, about the 30-year payment, being able to qualify for it. The reason this is a silver bullet with the new 50-year is that people will qualify based off the 50-year payment. And that makes it so those ratios that have been holding people out from being approved are now going to be low enough that we're going to be able to issue them an approval.
Yeah, I mean, there is some benefit to it, especially if people are trying to buy a home and their ratios are just out of reach. Mm-hmm. And again, this is all just math. But if we can stretch that payment out, and now that they're within qualifying ratios, yeah, they can buy a home. Mm-hmm. They can qualify. But I'd say that, we probably ought to look at the other side of that coin too. This is a big bonus, right? Yeah. People that have been wanting to build a home, buy a home, go from their town home, and now they've got 5 kids and they need more room. Mm-hmm. They need a yard. They need to, whatever it is. Does this open that door for them? Short answer is it could. Mm-hmm. It could definitely be something that could allow them to move forward. I'd be interested to see if this goes into all mortgage programs. We brought up several times in our podcast before, first-time homebuyer programs. Are they going to venture that way too? Are they going to do that, or are they going to allow home buyers that don't want to put any down to go on a 50-year also? It's all, it's all being calculated. It's all being looked at. Who knows? Yeah. We'll find out soon enough, I'm sure, but it could be a silver bullet to move things forward. But we probably ought to explore and look at the other side of that coin too. Yeah, for sure. And that's a great point. If it's just going to be under the conventional, standard conventional financing where they have to come up with 5% down or more, and we don't even know with this program, what are going to be the down payment requirements. I'm assuming it's going to mirror the 30-year. We don't know because it's not even out yet, but once it does, but you have a good point. Is it going to be something that's offered on, FHA and VA and some of your first-time homebuyer grant programs? We have USDA,
no idea.
Where's it going to fit?
We don't know. We have no idea which programs it's going to fit under yet. And even there is still the question of, will it roll out? So we think so. We think so because there's some positivity behind it. But you're right. Just like anything you consider in life has pros and cons. Anything has, you need to weigh it out. You need to do your due diligence. And that's what we're going to talk about here today is this is a sword that has two sides to it. There's two edges. And, you and I discussing casually over the last 2 weeks since this thing has been introduced, one side has a lot bigger blade. Yeah. To you and I, we kind of see that on the side of the cons a little bit, and we're not going to hold back. I think we're going to share that with everybody today. Yeah. Keeping continuity with that positive edge that we're talking about, the first-time home buyer, it could be a solution. The people that need to go to their next home could be a solution, but there's also the benefit to potential home flipper. Someone who wants to buy a home, sit in it for a year or two, take advantage of a smaller mortgage payment while they're fixing and flipping, type of thing. But if you're planning on being in this home as your forever home, or for 10 or 15 years, it may not fit. It may not be what you're looking at, but for a short-term adjustment, short-term Band-Aid, it could be a beneficial thing. I think you're exactly right. It's the average person that buys a home, it's long gone are the days of somebody that would set up a 30-year mortgage. Yeah. And hold it in its entirety from day one all the way through and make that final payment. I mean, I think there's, we can look at statistics on that. It's far less than 1% of the people that get a new mortgage end up holding it to the end. And I think with the 50-year mortgage will be no different. I think we're going to see that average of people being, either refinancing, selling, moving, whatever it is, whatever mortgage they put into place, typically between 5 and 7 years. by year 10, they are going to either refinance, sell that home, move on. So this will not be a product that I see a lot of the world holding on to for 50 years. But if they do hold on to it for 50 years, let's talk about that picture.
Just as you were saying, 50 years, I was thinking, when I go to closings, people are looking at the promissory notes and it's showing, if they're signing today, their mortgage is going to be paid off in 2057.
Yeah.
It's 30 years.
Yeah.
Or, sorry, I added 2 years to that for some reason. 2055.
2055.
I don't know why I said 2057, but so 2055. Can you imagine going to the closing table saying, yeah, this is going to be paid off in 50 years, 2075.
Look at me. I'll just say it. I'm 53 years old right now. So I'm going to pay off my 50-year mortgage when I'm 103. Good luck collecting on that. I think I'm going to be on the other side of the...
Take your vitamins, Dave.
Yeah, I'll be under the other side of the ground here. So, that's one thing to really take in consideration. I think this is really a program. If we're going to hold it out for its entirety, let's hope they're in their 20s or 30s when they do this.
For real.
Because that last payment's going to come a long ways down the road. Now, obviously, anybody out there that's listening today, there's something called an amortization table. Yeah. Whenever we go to a closing on a 30-year mortgage, we show that, like you just said, that final payment being the showing on an amortization table, and it breaks that table up and it shows this is the amount you pay over the life of the loan, and this is how much went to principal, and this is how much went to interest. Okay, that's what an amortization table shows. Let's talk a little bit, Kyle, about the difference. I think we both pulled up some tables here, but talk a little bit about, your average purchase price, average loan amount, and what it looks like in difference from a 30-year, the old school garden variety 30-year loans that we were doing, and how much they'd pay in interest versus the 50-year.
Yeah, very good. So I pulled up some numbers, and just for comparison's sake, I wanted to put somewhat of a current market rate, a little bit perhaps on the higher end, but on a 30-year, and again, rates have trended down recently, which is really nice, but I used an interest rate of 6.125.
Mm-hmm.
And just for straight comparisons, I used the same interest rate on a 50-year.
Okay.
What does that do to my monthly payment? And it does make some adjustments. It's about a 250 year or a $50 payment-ish.
Mm-hmm.
Pretty good benefit. So, does that materially change someone's outlook on buying a home? Yeah, $250 is pretty awesome.
Well, let me ask you there, I'll just interject really fast. How often have you had people, when someone comes in and we have to look at the new mortgage payment plus their existing debts, and then we have to, do that ratio comparative of their gross household or qualifying income. If the maximum is going to be 48% or 49% with that product, or even 50%, whatever the product approval is, how often lately in the last few years have you actually had where someone just misses it because they're at 52, 53%?
Oh man, all the time.
All the time.
All the time. It seems like if we're trying to help somebody reduce their other debts or see what they can do to bolster their income somehow or get a cosigner, it's because they're just out of reach slightly. They're just barely out of the qualifying range. But $250 adjustment could help a lot of people qualify.
That in most cases we're talking, I think, $250, depending on what their gross qualifying income is. But a $250 debt difference in monthly payment on the debt side, we're talking something that is very likely 5%, sometimes 7% of someone's income. So that 5 to 7, the reason I asked that question earlier is if someone is hitting 52% and you're saying, sorry, we cannot qualify. We've analyzed this thing to death. There's no way to make this fit. We've tried everything. We got creative with the mortgage insurance, whatever it is, we can't get this to work. But now if you have a 50-year option you can go to, and it's going to drop them down to 47, 45%.
Now they're in.
Now you get to tell that person, hey, congratulations, you're going to be a homeowner.
Let's get you in there. Yeah. So yeah, that's where, and I think that's where the FHFA, president is excited. That's why it's being introduced is for those borderline qualifying applicants that are just almost there. That really, if something were to change for the positive, they would be there, but it's just not going to happen in the near future, perhaps.
Yeah.
Maybe they've got some car loans or they've got some credit cards, but the cash isn't there to reduce those debts. So what can we do at that point? well, we stretch out their payment a little bit on their mortgage. And so, yeah, then they're in. But, the one thing I didn't do, I don't believe, unless I forgot, is give an average loan amount for my calculation here.
Okay.
So I'm using a $400,000 loan in this. And so with that, using the same interest rate for both, it's about a $250 positive reduction in the monthly debt going to a 50-year.
Gotcha.
But again, if you were to maintain that mortgage, okay, and the chances of that interest rate being the same for both products, 50-year and a 30-year, pretty slim.
Yeah.
I would say that's probably not going to be the case. Your 50-year, it's going to be a little higher, quarter to 3/8 higher is my anticipated guess on that.
I think that's a very good guess, because as we look at right now, all we can really compare it to, because obviously the product's not out yet, we look at a 15-year mortgage versus a 30.
That's about that adjustment.
That's about the adjustment. Sometimes we see it as a 0.5% difference, and we're going, if it's 15 going to 30, if you go another 15 years, that's 45. We're going all the way up to 50. It's very likely this could have a 0.5% higher interest rate, or 3/8. I think you're right in the mark.
Yeah, I agree with you. Here's the difference I see, and maybe I'm jumping too far ahead, but the total interest payment over that time, it's never fun when you're looking at that document at closing that shows, your total expense for your mortgage, paying back the mortgage plus all the interest you pay. I'd rather just move past that one as fast as I can when I'm closing on my own home loan, But in this instance, a 30-year loan, $400,000 mortgage, with a 6.125 interest rate, you're going to spend about $475,000 on interest. Okay, so you're doubling what you're paying for this home and more with interest. But where the rubber hits the road for me is when I look at the 50-year. Again, same criteria as the 30, just stretching it out 20 more years. Actually, doubles the amount of interest you pay.
In some cases, I look at it, it doubles, or just even a little bit more than doubles.
Yeah.
Depending on what that rate's going to be.
It's startling to me, and we're conservative and we're financially minded. We try to make sure that our clients are always getting the best deal possible. So would this be a good product for somebody to just hold on to forever? No, I haven't seen. If they're qualifying or they're almost qualifying and they can almost just get into that range, if they go to 50 and it's a short-term fix, it could be a thing, but man, refinance it as soon as you can, right?
Exactly. And we talked earlier about the average person that buys a home, that mortgage will be left in place, we're going to call 7 years, because that seems to be the industry average. Whether they're going to refinance, sell that home, move into a different home, whatever it is, that 50-year mortgage, let's just say they get into a mortgage, it's a 50-year mortgage, they're going to sell that or refinance that in 7 years. So really what we need to do is take a look at what does that snapshot in time look like at 5 years, 7 years, something like that, when they do go to turn on this on a 30-year versus a 50-year. Let's talk about that for just a bit, because that is significant, because that's where somebody is going to accumulate some wealth.
Yeah.
Because they're going to pay their principal balance down over that 7-year period. And that's typically when you go to refinance, you're like, okay, now all of a sudden I've created some of this equity. My value of my home went up a bit, but my principal balance dropped on my 30-year by X amount. So now I've got this wealth, this equity position. Let's talk about the difference of that equity position on a 30-year versus a 50-year.
Yeah.
And I think this is really the most important, I don't want to say startling, I almost use word startling, what the heck? Well, startling fact that people really need to consider when they're looking at these two different programs.
Yeah. And the math doesn't lie, No. So here's the thing. Nobody likes to look at an amortization table,
right? Especially
the first page of it. It's terrible. I mean, you feel like you're paying a lot of money and it's not going anywhere.
Yep.
The last couple of pages of your amortization table, and then it gets interesting, right?
Yeah.
So in building out the question, how much, if you're getting, again, a $400,000 loan and trying to figure out what kind of wealth you're building as you're paying down that debt, when is it that you actually start to see an adjustment, And so I did a quick calculation and thought, if you held on to this for, let's say, a year, let's just go there. Where does that go for you? How much equity do you build in a year? And on a 30-year, you pay down your debt about $5,000.
That's significant in the first year. Yeah.
Yeah. So that's a 30-year. So on I got to scroll up here. On a 50-year, how far do you get in your first year of payment? And that one's not as exciting because you're paying down your principal balance about $900.
So $5,000 in your pocket versus only $900.
Yeah, barely scratching $900.
And you've saved $250, $300 a month in payment.
Yeah. So
But you got in the home, you qualified, but now your equity position is 1/5, less than 1/5.
Yeah. And my immediate thought as I calculated this is like, who's really the biggest winner in here? It's the banks.
and that's what we're reading on all these posts is we're making people, we're not making anybody do anything, but people that might choose this program, it's already bad enough. The joke has always been, well, the bank owns my home. And that's true. When you have a mortgage, the bank is in first position on that thing, right? You own the home, but the bank obviously needs to be paid. They're the first position lien holder. This is going to extend it much greater, and you're going to be paying a ton more interest. And if you're going to try to turn and burn on this thing in 5 or 10 years, you're going to be owning a less percentage of that than you would have under a shorter term mortgage.
Yeah. So the other calculation I wanted to run is, how long does it take you to build or pay down your mortgage? About $10,000. If the math stays true on the 30-year, it's about 24 months.
Yeah.
So you're about 2 years, a little over 2 years to do that. How long does it take you on a 50-year to pay off $10,000 of your mortgage? I'm still scrolling here. Scrolling down here. It takes a little over almost 7.5 years.
So how many, on the 30-year was how many?
25 months.
25, so a little over 2 years, and it goes to 7.5 years.
Yeah, 89 months. So that's about as long as people typically stay in their homes, 5 to 7 years. In 7 years, you're going to obviously pay off a drastic change in your principal balance on a 30-year.
Yeah.
On a 50-year, I mean, hopefully the market just keeps improving because your equity is, it's not going anywhere fast.
They're putting a lot of faith. We've always had this where, you just said it, where the values of the home are continually increasing over time. And in history, we can look back. That's one thing you could always set your watch to, is that your home value is going to continue to go up. We're completely betting on that with a 50-year mortgage.
Yeah.
Completely betting on that. So obviously, that part's not that great. Now, going back to the one positive perk of this thing is that qualifying, people are going to get into more homes. And what does that mean for the market? If we're going to have more people qualifying, let's talk about that for a little bit. Financially, do you think we should cover any more on the financial side of it?
No, I think we covered and shown a pretty drastic comparison between the 30 and the 50.
Yeah.
Going from 360 months to 600 months.
That's a weird thing to think about. 600
months.
600 months. That's wild. Okay, so people are going to be making a lot more in payments over the life of this thing. Obviously, just the total payments they make are going to be much, much more because you're adding that interest to the principal paid back. So, but we're getting more people into homes. We're getting more people qualified that wouldn't have. Now, on that financial piece, obviously the 50-year mortgage.
That's next year.
Yeah, that's next year. We'll introduce the 500-year, and then homes for everybody. It's better. The 50-year mortgage is better than renting. Am I right?
Yeah, I guess so. I mean, the property's in your name.
Yeah.
You can change the color of paint without asking a landlord. But and you can make this argument with a 30-year too, right?
Yeah.
You're still, like you said, you really don't own the home. The bank owns the home. You do own the home.
You do.
And this is the same story with a 50-year. It's still your home. You've purchased it, but there's a lien against it in both scenarios. You just won't own it outright.
Yeah.
As fast.
Yeah. You're exactly right. So more people are going to qualify with it, and it is good to own your home versus to rent your home. So we're going to get more people into it. So let's talk a little bit about the potentials with the housing market.
Yeah.
Macro, micro, locally, nationwide, however we want to look at it. What do you feel as I look at this thing, and I think people are going to be qualifying for more? We're going to get more people into homes. there's a very real thing that people are talking about out there right now that is the concern that as more people are now qualifying, much of this is supply demand driven, but that we're going to see prices start to climb again.
Yeah. Well, I mean, that's just basic economics.
Mm-hmm.
If you flood the market with more buyers,
Mm-hmm.
the supply line is going to shorten, and that's our biggest issue we've had lately is just a lack of housing.
Mm-hmm.
If we flood more buyers in there, it's going to naturally push prices up.
Yep.
This might be a solution for a very short time.
Yep. And it's going to, and I think that's a very likely thing to happen. And if prices continue to go up, what does that mean for everybody? Obviously, the 30-year payments are going to go up even higher for those of us that would be buying otherwise. And if this 50-year product didn't come out, is that needle of home prices, if it doesn't come out, would it move as much as if this 50-year had not come out? That's a big question.
And I think, this is just my opinion, of course, I think we're fighting the economics on this because there's ebbs and flows in the real estate market. There always have been.
Yeah.
Things get hot and then they slow down because rates are up or purchases or, prices are up. And so things have to cool down a little bit naturally. And when they do, people can buy.
Yeah.
And we keep fiddling with that and messing around with the economics of it, trying to find a Band-Aid just to get people in homes, which people need homes.
Mm-hmm.
And you and I, we feed our families from doing home loans.
Yeah, we do.
We like it when people buy homes.
We do.
We absolutely love it. But at the same time, economics is a science.
It is.
And it works. And if we try to artificially inflate one end of that, it's gonna inflate the other end.
Yeah. You look back in history and, we brought out the concept of the 40-year mortgage. It came out even back in the 2006-07.
Yeah, I remember that coming out.
It came out, and it was a product, and it was for the same reasons, because we were getting these home prices in 2005, 6, 7. They were going up pretty drastically in those days. Same type of situation that we were dealing with today, where people were struggling for affordability. So they brought out that 40-year. And then when the market took its big correction in 2008, it was a tough year for the whole economy. They limited mortgages back to 30 years because of that. So here we are now, fast forward through from 2008 to today, we're just under 20 years, we're 17 years further. And now we're talking about not even reintroducing the 40-year, but going all the way to the 50-year. So it definitely raises the concern about it's going to increase debt levels of people. People are going to be under debt longer, and that's not a good thing, especially with our credit card debt nationally right now.
Yeah,
that's and I hate to be the guy on this podcast right now. I hate to be the doom and gloom guy that's going to bring out all the bad things, and that's not my point here, folks. What I'm trying to just talk about is some of there's pros and cons of this whole thing. Obviously, getting more people into homes is a wonderful thing.
Yeah,
but I don't want to see it, straddle people to inevitable, debt that never goes away, and I don't want to say artificially, but economically pump up the home values even higher.
Yeah. And honestly, I'm curious what other people think about this. So, viewers, tell us what you think, leave us a comment. I'm happy to have someone tell me that I'm wrong. That there's a better way, that these are, in your opinions, the way to go. Or if you agree with us, I'd love to hear about that too. But, it's interesting, just thinking back to the 2006, 7, 8 times where we had negative AM loans and we had interest only loans for the same thing, to help people afford to shrink down that payment. And those went away because they're not viable. Yep. People were getting negative on their equity and it caused a big problem. We know that. We lived through it. So, is this a creative way to get people in a home? It could be classified as that, but I think it's a short-term Band-Aid. Yeah. But it could do more harm than good.
So you think it could just be a fad or like you say, a short-term Band-Aid, something that could come out and it could be a benefit for a while, but could be like that 40-year that we saw in 2008 that could be pulled back.
Yeah.
I think it possibly could. So my biggest question I have is really when I start thinking about these The people that this is really targeted towards are going to be your people in their 20s and 30s, maybe younger people that really want to get into that first home, and they want to be able to qualify and have a payment that's a little bit softer that they can afford. My question is, do you think they care, and any of you listeners out there chime in, do they care about the big picture, the debt picture, and the things that we've talked about so far? I think we're fortunate right here. We have a guy that's actually videoing. We've talked about him before. Logan is the perfect example of somebody that would love to be able to qualify for his first home. And we've talked about this all the time when we're off the air here, not videoing. So let's ask him that question. Logan, we're going to ask you a question. What do you think about, we've talked about the pros and the cons of this thing. You want to get into a home pretty bad. You'd love to qualify for home. Does that big picture of how much longer you're going to be carrying that principal value in debt, is it significant enough for you to not want to do the 50-year? Or do you want to get in the home so bad you'll do the 50-year and not worry about those things?
No, not at all. I think that it deters me from buying a home a little bit. That massive debt that you're going to have after 50 years of you've paid off 3 houses by that point, that definitely stops me. My very first thought when this 50-year mortgage idea came out was, oh, good, you get into a house, you finally qualify, you pay on it for 7 years, and then you refinance into a regular mortgage. But now after Kyle just broke down those numbers, I don't think that that's a possibility either.
It kind of, I think startling is a good word still there.
Yeah.
But I appreciate your insights on that. And of course, our ambition for this podcast, for educating our buyers, is to not be like, you shouldn't buy a home.
Yeah.
Because again, we feed our families because we do this kind of stuff. But we do our best to try to educate and help our buyers to move upward and not get in trouble.
Yeah.
And so we share our opinions, and we've been doing this for a while. I mean, between the two of us, 50 years of experience.
Yeah.
Pretty awesome.
Yeah, and it's nice to be able to look back through all those, and with that combined experience we're talking about all those years, we can look back at these different economic times, and we can remember back to the days when we were quoting people payments of $700-800, $1,000, $1,200, and now $2,500-3,500. It's been a big drastic change, and I love being able to see the contrast of the different times that we've all faced. So Logan, thank you for your insight on that, because that is extremely valuable. I look at this, and you said it just right. We're not trying to boo-hoo on this whole thing. If it's something that's going to come out, and if it's going to be a good fit for some people to get into a home, and hopefully they can capture some of that equity that as that home does appreciate in value, if they can get in, and even though they're going to pay off less principal, maybe it's the right product for that person. And here's one thing to consider. I'm going to throw this out there. There's a lot of people that come to us and they want to qualify for a mortgage. Their ratios are right down with their qualifying income. Their ratios are right on the bubble. They can't quite do it. The 50-year would take them over the line, right? Now to qualify. Those same people may be people that also hold a second job that we're not able to give them credit for in qualifying. Maybe they have a second job. Maybe they have a side business that they do from the house where they're making widgets and selling them. I don't know what it may be, but they have additional income to help them service the debt. So it's like we're only able to look at their whatever income it is that they've got a history with that's on their pay stubs. So if they have additional income and they just need to be able to get their foot in the door, here's one thing I'm going to throw out there. And I think any good mortgage lender that might be listening to this should consider this is put them in that 50-year and encourage them to accelerate their payments. Anything you make in your monthly payment that is above the minimum payment is going to go 100% to principal. If you want to get away from the downside, that other side of the sword of the 50-year, and you have that additional income and you're not, living house poor, the 50-year gets you in the door. Now do what you need to do to make the payment that's closer to what that 30-year was. And guess what? You're going to have a picture that's a lot like the 30-year.
Yep.
So in that case, I see this 50-year as a big plus. I see it as something that is going to be a gate crasher that's going to allow people to come in that would otherwise not. My one fear that I will say, and we've said it already, I don't want to see the market out there think, okay, we're having a run, all these homes are selling, now we can raise these prices up, because the whole supply-demand thing. That part scares me. It makes me worried because that's the market shouldn't move only because a new financing product that came out.
I agree. And I think it's wise, if people can get in there and aggressively pay their principal down, like as if it was a 30-year or a 15-year, but that qualifying range for the 50 allows them to fit in the box. I hate to say it that way. It could certainly be an awesome way to get people into a home, as long as they play it smart.
Yeah.
If they got $40,000 on a credit card and they're paying that $15 a month minimum payment, same principle. They'll never pay it off.
Yep.
It's like getting a cheap gym membership, but you have it forever.
Yeah, and you never go. There's so many people there that'll just, if you're going to play the minimum payment game, it's going to come back to swallow you. That just does. And people just need to focus on the bigger picture. And as long as you're using this as a tool to get in the door, so by all means, so be it, do it. And I think that's where we really need to, as lending professionals, we need to be able to sit down and I think we're going to need to, it's our duty to give them caution.
Yeah.
To sit there and tell them all this, to show them in this breakdown. And it wouldn't shock me if the federal government has a new a disclosure that goes along with this. Maybe they will, maybe they won't. That's in your disclosure package when you get a new loan, that you understand what the 50-year really looks like. And I think we're going to need to talk about that up front with people and just let them know. But if it gets people in the door to home ownership, kudos. I think that's great. Great idea.
Yeah. And, I was just thinking back a year from now, or a year ago, where interest rate were. We were knocking on 7%, and now we're in the low sixes, high fives. And so I think with time, things are correcting themselves naturally.
Yeah.
I think, with our last podcast, we'll be in the fives.
Yeah.
I think in this next year, we'll be solidly in the fives. And that by itself is going to allow people to enter into that home buying scenario. But I always encourage good fiscal responsibility. Pay your debts down, try to be as debt free as you can, work hard at your jobs, get those promotions, whatever you can do to better your financial ability. That is a way that is sustainable.
Yeah.
Is the 50-year a gimmick, or is it a real blessing? Yes.
Yeah. The answer is yes to both.
Yeah.
But I think if it's a tool that's going to give somebody home ownership that otherwise wouldn't have been, as long as they're going to be fiscally responsible.
Yeah.
This is a great idea for a lot of different people. And if it rolls out, I look forward to being able to, use it as a tool to help people. And I think we just really need to focus on it to help people.
Yep.
It's not to give them enough rope to hang themselves. That's not what we're looking to do. Anyway, that's been a good discussion. I hope that the people that have listened to this, I hope they've benefited from it. I do want to make a point right here, and we need to do this at the beginning, middle, and sometime in every one of them. Those of you that might be watching us, we appreciate it if you would subscribe and like this. It helps a lot for us to be able to gain a little bit more traction and be able to continue to bring out these podcasts. They're really designed so that we give information to people that might be looking to get into home ownership. We try to bring in guests that are people in all facets, all angles, all corners of our industry that will be able to help people to get the information they need. So please subscribe, like, share, whatever you got to do. We'd appreciate that. Any other points that we've missed? Anything else you want to talk about?
No. I think this has been a great discussion. Hopefully, we see rates trend down. I think we will. Now that the government's open, we're going to have that information to help us move forward and just improve. And so, we'd love to be a resource and an avenue for questions. And so if you do have questions, you have opinions about what we're talking about here, hit us up. We'd love to be able to chat with you. Love to be able to see what we could do to help you qualify for a mortgage or build a home, whatever you'd like to do that way. We're both experienced and know exactly what we're doing here. So anyway.
All right. Well, thanks everybody.